Ladies and gentlemen, I need you to understand what just happened in the physical gold market because this is the kind of signal that separates the informed investors from the ones who get blindsided by major moves. This is the kind of data that the Wall Street analysts do not discuss on television. This is the kind of information that moves billions of dollars in the shadows while retail investors are distracted by headlines about volatility and uncertainty. The two largest gold-consuming nations on planet Earth just flipped from discounts to premiums simultaneously. India and China, the twin giants of physical gold demand. The markets where gold is not a trading vehicle but a cultural necessity, where families pass down gold through generations, where weddings and festivals and savings are measured in grams and ounces. These markets just send a signal so loud that anyone paying attention should be sitting up straight right now. Let me give you the numbers, because numbers do not lie. Numbers do not spin narratives. Numbers tell the truth, even when the mainstream media would prefer you look elsewhere. 1 week ago, Indian gold dealers were offering discounts of up to $61 per ounce, below the official domestic price. $61. That is an enormous discount. That is a market that was screaming that demand had collapsed. The record high prices had pushed buyers to the sidelines. The jewelers were sitting on inventory they could not move. The retail consumer, the backbone of Indian gold demand, had stepped back because the prices felt too high, too fast, too risky. But look at what happened this week. Those same Indian dealers are now charging premiums of up to $15 per ounce over the official domestic price. We went from negative 61 to positive 15 in the span of 7 days. That is a $76 swing in the physical premium structure. Let me say that again so it sinks into your consciousness. $76 in 1 week. This is not normal market noise. This is not random fluctuation. This is a seismic shift in the supply and demand dynamics of the world's second largest gold market. This is the physical market screaming at the top of its lungs that the correction was a buying opportunity and the smart money took it. And India is not alone in this signal. China, the world's largest gold consumer, has also flipped from discount to premium. Last week, Chinese gold was trading below the global benchmark. This week, it is trading at a $3 premium above spot. The direction matters more than the magnitude here. China has shifted from selling pressure to buying pressure. The bid is back. The appetite has returned. Now let me put this in context because context is everything when you're trying to understand what the market is really telling you. Domestic gold prices in India dropped from a record high of 465 rupees per 10 grams to around 136,700 rupees. That is a meaningful correction. That is approximately a 3% pullback from the all-time highs. And the moment that correction happened, the moment prices retreated even slightly from the stratospheric levels, the buyers came rushing back. This tells you something profound about the nature of physical gold demand in Asia. The demand was not destroyed by the rally. It was not eliminated. It was not replaced by some alternative asset or some change in cultural preference. The demand was merely suppressed by prices that had moved too far too fast. It was waiting, coiled, ready to spring the moment an opportunity appeared. And that opportunity appeared this week. The correction created a window, and the physical buyers climbed through that window so aggressively that they swung premiums by 76 in 7 days. They did not wait for lower prices. They did not wait for confirmation that the bottom was in. They saw value relative to the record highs, and they took it immediately. A New Delhi-based jeweler confirmed exactly this pattern. Retail buying improved this week after prices corrected sharply from record high levels. The improvement was not dramatic. It was not a frenzy. But it was real, it was measurable, and it was enough to completely reverse the premium structure from deep discount to meaningful premium. But here is where it gets even more interesting. Here's where you need to understand the psychology of the buyers who are still on the sidelines. A Mumbai-based bullion dealer with a private bank made a statement that reveals the tension in the market right now. He said that many buyers are holding off on purchases because prices are volatile and they are unsure which way the market is headed. Read that carefully. The buyers who are waiting are not bears. They are not sellers. They are not people who have lost faith in gold. They are people who want to buy but are waiting for clarity. They are people who will eventually capitulate and buy at higher prices when that clarity arrives. This is the classic setup for a squeeze higher. You have aggressive buyers who already stepped in and are now sitting on positions purchased at a discount to last week as highs. You have cautious buyers who are on the sidelines waiting to chase. And you have very few sellers because anyone who wanted to sell at record highs already did so. When the cautious buyers eventually enter, who sells to them? At what price? The answers to those questions determine the next leg of the move. Now, let me talk about China, because the Chinese market is confirming everything we are seeing in India. Independent analyst Ross Norman, one of the most respected voices in the physical gold market, made a statement that cuts through all the noise and speculation. He said that Chinese retail demand remains relatively robust, and especially so if you consider where prices are just now. Long and short, Physical demand volume remains pretty robust after a good correction in prices. Let me unpack what Ross Norman is really saying here. He is saying that even with gold near all-time highs, even with prices at levels that would have seemed impossible just a few years ago, Chinese retail demand is robust. Not weak, not fading, not collapsing, robust. Think about what that means for the structural supply-demand picture. Chinese consumers are not scared away by record prices. They are buying into strength. They are treating every correction as an opportunity to accumulate more. They're converting their paper wealth into hard assets at a pace that maintains robust volume even at elevated price levels. This is not speculative behavior. This is accumulation behavior. This is the behavior of buyers who believe that today's record high is tomorrow's floor. This is the behavior of a population that has seen what happens to paper currencies over time and has decided that gold is the answer. Peter Fung from Wingfeng Precious Metals noted that recent price volatility discouraged some customers amid thin holiday volume trading. That is true. There's always price sensitivity at the margin, but the aggregate result, the net outcome of all the buying and selling decisions across the Chinese market, is a flip to premium. The buyers overwhelmed the sellers. The demand exceeded the supply available at current prices. Now, let me walk you through what happened across the rest of Asia because the pattern is remarkably consistent. In Singapore, gold was sold at prices ranging from a small discount of 50 cents to premiums of 1.20 per ounce. That range itself tells you something important. The market is transitioning. Some dealers are still offering slight discounts while others are already charging premiums. This is the classic signature of a market in flux, moving from one state to another. In Hong Kong, gold traded at par to a 1 dasmati premium, no more discounts. The weakness has been absorbed. The buyers have returned. In Japan, bullion sold at par with spot prices. Flat, neutral. Neither aggressive premium nor distressed discount. Across the entire Asian physical market, the pattern is the same. The discounts that characterize the record high phase are disappearing. The premiums are emerging or have already emerged. The bid is coming back into the market. And here is why this matters so much for the price going forward. The paper market and the physical market are two different beasts. In New York and London, gold trades as a financial instrument. Futures contracts, ETF shares, options, derivatives. These markets are dominated by algorithms, by hedge funds, by bullion banks who can create and destroy paper claims with the push of a button. But in Asia, gold trades as physical metal, bars, coins, jewelry. This is real gold that has to be mined, refined, transported, and stored. It cannot be created out of thin air. It cannot be leveraged beyond the actual metal that exists. It represents the true balance of supply and demand in the real world. When the physical market flips to premium, it is telling the paper market that prices are too low. It is telling the algorithms and the hedge funds and the bullion banks that real buyers are willing to pay more than the spot price to get their hands on actual metal. It is telling the entire system that the fundamental demand is stronger than the screen price reflects. This creates a gravitational pull on the paper price. If physical buyers are consistently paying $15 over spot in India and $3 over spot in China, the arbitrage pressure builds. The price must rise to close that gap. The real world must eventually be reflected in the financial world. Now let me tell you about the timing of all this because the timing could not be more significant. Gold just ended 2025 with gains of 64%. That is the largest annual gain since 1979. We have not seen a year like this in 46 years. The rally has been historic, unprecedented, extraordinary by any measure. And yet, despite those gains, despite the record highs, despite the price levels that would have seemed like fantasy just a few years ago, the physical market is still paying premiums. India and China are not selling. They are buying. They are accumulating. They are taking every correction as an opportunity to add more metal. International benchmark spot gold kicked off the new year on a strong note on Friday, resuming its rally after that monster 2025 performance. The paper market is confirming what the physical market already knew. The bulls are in control. The trend remains up. The corrections are being bought. So what does this mean for you as an investor watching this unfold? It means that the smart money in Asia just showed you their hand. They bought the dip. They absorbed the correction. They flipped the premium structure from negative to positive in 1 week. They are not waiting for lower prices. They're not scared by volatility. They are accumulating with both hands. The question you have to ask yourself is simple. Are you going to ignore this signal? Are you going to listen to the Western analysts who keep calling for corrections and crashes? Or are you going to pay attention to what the largest physical buyers in the world are actually doing with their real money? The $76 swing in Indian premiums is not noise. It is not random. It is a message written in the language of supply and demand. And that message says that gold at current levels is cheap enough to buy aggressively. The physical market has spoken. The premium flip is confirmed. India and China are accumulating. The The setup for the next leg higher is in place. The only question is whether you're positioned to benefit or whether you will be watching from the sidelines, wondering why you did not listen when the signal was this clear. Stay positioned. Stay informed. Watch the physical premiums, like your portfolio depends on it. Because in the gold market, the physical always leads. The paper always follows. And right now, the physical is screaming, "Buy, I will see you on the other side."